Options basics, choosing a strike price. So this is a sample option trade that was executed in the last week of March going into April of 2016. But what I'm going to talk about is true for any time period, not just this past week. This is a high probability trade that we executed after we got indication that the market would be bullish on a Fed announcement. So basically on March 29th is Tuesday, the Fed spoke and basically they told everybody to jump into the market. And so the market rocketed it up. And yeah, sure, it's easy to say if you bought before the announcement, you would have made money, but we made money after the announcement. So after this big jump here, another, this is the hourly chart. There was one green candle, two green candles, three green candles, and basically it was basically 3 hours after the announcement that we executed this trade. And it was a high probability trade. Our bet was basically a bullish put spread, but our bet was that as long as this S&P 500 futures index, ES is the symbol, but as long as this index stays above 2032, then we will get maximum profit. In this case, it was about $450 in profits. So using this option strategy, we have a little bit of cushion. So you can see we executed this around 2045 and we have around 13 points of cushion. In case we're off by 13 points, we could still get our full maximum profit. It's the same amount of profit that we would get if the index closed at 2040, 2050, 2060, 2070. It doesn't matter where it closes. We still get maximum profit as long as we stay above this break-even line. So this green line is basically the estimated break-even line. So as long as we stay above this kind of trend line into expiration is on April 1st, that Friday. As long as we stay above this, at expiration, we'll get maximum profit. So what did we do? After the Fed announcement, 3 hours after the Fed announcement, we saw that the market would likely stay bullish for at least a couple of days. And even if it does dip, we don't expect it to go below, you see this little green candle here? We don't expect it to go below 2032. And so how do we pick a strike price to reflect that view? Well, remember our strategy is to look at the S&P futures chart in order to get a better sense of the S&P 500. But when it comes to trading options, you trade options on the SPY underlying ETF. So when you trade the SPY, how do you know what the corresponding value is for this rough area? Well, you have to look it up. So to look it up, I'm going to look at this chart and say, okay, so it looks like it's a 4, 1, 2, 3, 4, 5. This chart pattern I'm gonna find over here in Finviz, which is finviz.com, and you go into futures, indices, S&P 500, and you look at the hourly chart. And so this is that same chart, right? 4, 1, 2, 3, 4, 5. Right? So this is that same chart, just without the labeling. And this is all free to use. And then I'm going to go into investing.com. We're going to get this SPY chart for the S&P 500. But we're basically go to investing.com. I'll just show you right here. Go to investing.com. You type in SPY, you type that. All right, so we're getting the corresponding SPY chart. So you want the hourly chart. Well, first you want to, let's look at the interactive chart. See, this chart lets you zoom in and zoom out. You can go into the hourly chart, which is 60 minutes. You click this, and you can zoom out a little bit. And again, you have that same pattern. You have that 4, 1, 2, 3, 4, and then 5. So notice this period from, if you look at the bottom of the screen, March 23, March 24, that's where this bottom was. And you look at the corresponding chart, March 23, March 24, that's basically here. And what you want is, you want to target this region right here. and that's around right here. That's 203.8. And when you choose strike prices, they only have intervals of like 202, 202.5, 203, 203.5, 204. So to be safer, you always want to give yourself a little bit more room. So instead of shorting the 204 strike, you want to short the 205, 203.5 strike. So that's how you choose this strike price. You see, this SPY chart is the same as this futures chart from Finviz. The only difference is that the futures chart has overnight action, whereas the S&P 5, the SPY has these kind of gaps. You see this gap from here to here, and the gap from here to here. That's basically overnight action that it's missing. But if we want to bet that the market stays above this region, that would be the 203.5 strike to short. And that's basically corresponding to betting that it stays above this region here. So by looking at the futures chart, you get the full picture, but in order to trade it, you have to look at the SPY ETF, which only trades market hours and does not include overnight action. But you have to look at this chart to find out what the exact area is. Usually it's pretty close, right? So 2035, this region you could guess is probably SPY 203.5. It's usually off by a few points in either direction. Sometimes you don't even have to look at the SPY chart. You could just if you want to bet that it's going to stay above 2035, just short the SPY 203.5 strike. But if you want to confirm it, go to any tool, including investing.com. You can even use Finviz, Finance, Yahoo, anything you want to do just to confirm. Well, you make sure the pattern looks the same, and then you just look at it and you say, oh yeah, it is 203.5. And so based on that analysis, you could say, if your view, going back to our chart here, if our view is that we want to bet that after the Fed announcement, we want to bet that it's going to stay above this area, even though the price has already moved up to 2045. We want to bet, well, by Friday, we wanted to say it's going to stay above 2035, 2032, that region. Then you would choose to short the 203.5 strike. If you want to be a little bit safer and collect less money, then you can short the 203 strike. But we believe with decent probability that the market would close above this level. And yeah, it turns out that it got pretty close, but anything in this region above this green break-even line is maximum profit. So it doesn't matter exactly where it goes. So that's one of the good things about shorting option and using credit spreads. You can just kind of sit back and relax, and as long as it closes above this region, you collect max profit. So it turns out on Friday morning, it got close to break even. We were maximum profit, or we were on track to making maximum profit all along, and it got close to break even, but then ended up closing at maximum profit anyway. And so our option trade allowed us to capture that regardless of what the market did. So basically, this was like a 2 or 3 day trade. We entered the trade here, and we didn't even need to exit our position. It just automatically closes on Friday. And since the index closed at 2064.75, that's well above the 2032 level. So as long as that it stays above that, then we collect our maximum profit of $450. So when you're doing a bullish put spread, and I'll include a link in this video that links to our prior video that covers how to execute a bullish put spread. It's basically a credit spread, and you actually collect money by executing the trade. And as long as the stock index stays above your short strike, in this case we shorted the 203.5 strike, as long as it stays above that level, then we collect maximum profit. And just so you guys can see my execution, I shorted the 203.5 strike April 1st put, and I executed this. I forget when exactly or how much. This currently, I took a screenshot right before, um, on Friday as it was expiring towards zero. As you can see, the difference here is just 3 cents. But back when I executed this, this was closer to like 90 cents or 80 cents. So it drifted from the difference between these drifted from 90 cents down to just zero. And as long as this short strike goes towards zero, then you collect all that money. That in this case, I executed 30 contracts. I recommended 10 to my subscribers. Um, but if you executed 30, then you would have gotten 1.27K. And once you take care of this $130 loss, it's still $1,100. So that's this chart we just looked at. We entered here, and it automatically exited at the close for max profit. And this chart goes into a little bit more detail. So looking at this chart, basically, I'm saying, well, we entered the bullish put spread when the E-mini futures contract was trading at 2045, and that's after the Fed announcement rally on Tuesday. And this green line is the estimated break-even path of the option credit spread, this bull put spread, and we shorted it with SPY 203.5, which is roughly 2032. And we have April 1st Friday expiration, and as long as it stays above this line, we're in positive territory. And certainly by the close, it closed above this, closed well above it, and so that's why the options expired at max profit. So again, how do you choose which strike price to short when you're doing a bullish put spread? You have to have a view of where the market is going to stay above. Whichever that level is, you want to find the corresponding value in the SPY, which is usually pretty close. So if we're talking about 2035, then SPY would be 203.5. And you can check that by looking up the SPY chart. So you want to short that 203.5 strike price, and then the strike price that you want to go long would be, roughly 5, maybe 6 away from it. So if you're short the 203.5, I went 5.5 dollars below that, so that's 198. So I went long the 198 put. The purpose of the long put is not to actually make money from it. The purpose is to satisfy margin requirements from your brokerage so that you don't have unlimited risk. But basically, you want to long the strike price that's about $5 or $6, just enough so that you're capping off your risk, but not enough that it takes away from the amount of money that you might collect. So in this case, we shorted the 203.5, long to 198, and collected that difference. And this ultimately cashed out for about $1,200. To learn more about options, S&P 500, Elliott Wave Theory, and more, check us out at lifestyletrading101.com.